sponsored by the Securities and Exchange Commission of Nigeria.
The first bond recorded in Nigeria was issued in 1946. However, by the early 1990s, the stock market had become dominated by equities amid a waning appetite for bonds. Stakeholders recognized the need for a thriving fixed income market and embarked on a campaign to resuscitate the bond market. This led to a string of reforms that really gathered pace at the turn of the century.
Before 2003, the bond market had been, if you like, comatose for more than 18 years. In 2003, the DMO, working in collaboration with other agencies, SEC, CBN, Ministry of Finance, and of course the capital market operators, decided to resuscitate the market. 2005, we now decided to issue bonds on a regular monthly basis. And that means we have issuance programs that covers the whole year, but most of the time are specific for particular quarters. So you could say since July 2005, we've been issuing bonds on a regular monthly basis.
By 2006, the federal government bond market had been reorganized with monthly primary market issues and a burgeoning secondary market. A 20-year yield curve for pricing other bonds had been established, paving the way for subnational and other issuers to raise long-term capital in the bond market. The development of the Nigerian bond market has happened in the context of similar developments across the African continent in recent years. The changes have attracted foreign investors, and the year 2012 saw a significant growth in foreign interest in African bonds.
If you look across the African continent, interest rates are particularly high, sub-Saharan Africa especially. Kenya, Uganda, they have cut rates now, but they had much higher interest rates in late 2011, early 2012. Ghana, Nigeria, double-digit interest rates, and in some cases, in the case of Nigeria, relatively stable currencies. This made it very attractive for offshore investors to borrow at their historically low interest rates and invest in these markets. You have quantitative easing 3 being introduced in the US this year. You have the global environment of easy money and record low interest rates. Investors are looking for yield, they're looking for return. And if they can find a currency where fixed income securities yield double-digit returns and the country's currency is relatively stable, as the Naira has been over the past few years, then inevitably there will be a lot of interest in buying those securities from offshore, and that's what we're seeing.
Portfolio investors are very savvy, and it's very easy to follow where the money is. So first, if you look at globally, there's been a lot of confusion around what's going to happen in Europe. Is Greece going to break out of the Eurozone? What's happening in the United States? But there's another phenomenon. There's a lot of global liquidity because of monetary easing in the United States, some monetary easing in the Eurozone. So there's a lot of global liquidity. So the question people ask themselves is, where is the value? And there's value in African markets. So if you look at Nigeria, in January, yields were as high as 20% on short-term instruments. Yields are in excess of 20% in Ghana, and you see relatively high yields in other African markets. We don't have to look too far back to have seen this happen before. It happened in 2006, it happened in 2007 before the crisis, where there was a lot of global liquidity. People now start looking at emerging and frontier markets for value. Right? And when they see value in those markets, they'll put money there.
One key factor that enabled the flows into Nigeria was the decision, with effect from July 2011, of the Central Bank of Nigeria to lift a restriction requiring foreign investors to hold government debt for at least 1 year. The move was designed to attract new foreign portfolio instruments and help stabilize the Naira. The Securities and Exchange Commission also introduced changes designed to stimulate the subnational bond market.
We're seeing some of the dividends of the reforms that we embarked upon as the Securities and Exchange Commission Nigeria over the last few years. One of them is to make it easy for corporates and subnationals to come to the market. You of course know that there was a tax waiver which was granted in 2010, which basically meant that there was no discrimination between the federal government from a tax point of view and the subnationals and corporates. But I think also more important is the fact that we established the opportunity for issuers to have a shelf program, which then means that they can issue, they have the same documentation, and they can issue future transactions on the basis of that documentation.
The story of Nigeria's bond market in 2012 could be described as a tale of two halves, with the market shaped by the changing interest rate environment and investment flows from offshore.
It's been a very interesting story in 2012, and we've seen a return to the activity that we saw, let's say, in 2007, 2008, prior to the financial crisis. So the start of the year was all about the currency, where the central bank was trying to do everything it could to make sure it stabilized the currency coming in from last year. The value in the short end of the curve, i.e. in treasury bills and 1 year and less securities, was a lot higher in the longer end of the curve. So just give an example. At the beginning of January, 1 year yields were as high as 20%, but a 5-year bond was nothing more than 16%. So from an economic perspective, banks, who are the biggest investors in the securities market, and even offshore investors, all their investment was skewed to the short end of the market. Pension funds, who are long-term investors, were still buying in the bond market, they were still investing in the bond market, but all the money that they had kept in money markets, in short-term instruments, and even the maturities that they were having, a lot of it was being skewed or moved towards the short end of the market, simply because there was so much value in that end of the curve. Then going through the later parts of the year, most of the activity came from the inclusion of Nigeria in the JP Morgan Global Bond Index. So in the bond market itself, I would say in the first half of the year, there was very little activity. But by the time we got included in that index, in the later half of the year, then we saw a lot of activity in the bond market.
Overall, fixed income secondary market volumes are up in 2012 versus 2011, driven principally by treasury bills. Treasury bill volumes are up about 30% year on year on the secondary market, while bond volumes are actually down about 11-12%, though they've picked up since the introduction of Nigeria to the JP Morgan Emerging Market Index. So in global terms, in terms of fixed income securities, secondary market volumes are up about 7%, which is good. The first time in 3 years that secondary market fixed income volumes are up. It's an indication of the greater interest in the Nigerian market. And the trends we see are likely to be sustained in the future as Nigeria becomes much more interconnected with the global market. You've seen bond yields come off very sharply and prices commensurately rally. The way bonds work, if yields go down, prices go up. So you've seen yields come off about 350 to 400 basis points across the board between the 5 and 10-year tenor buckets. And that has seen the prices rally significantly. 10-year prices are up about 20% between August and now. 7-year prices up about 15, and 5-year prices up between 8 to 10%. So that has been the impact of the increased foreign interest, specifically in the bonds. It has caused significant price movements.
We've seen a pickup in activity in the bond market in the second half of the year, based on our estimates about 30 billion. So it's a slight drop from last year, but still quite active. So total market size, if you look at bond and T-bills, is about $40 billion, 38 to $40 billion, which makes us the second biggest market in sub-Saharan Africa outside of South Africa. So it's been a very liquid, well-traded market.
What has been great this year, particularly, is the admission of the federal government bonds to the JP Morgan Global Bond Index. What it's done is, from August, when there was the anticipation of this entry into the JP Morgan Index, we've seen more than $1 billion of money come into the bond market in Nigeria. But I think what is even greater is that people have focused on Nigeria as a preferred investment destination, and people have therefore looked at the variety of investment opportunities that Nigeria has to offer.
It's been clearly a quite eventful year for the federal government bond market, but less so for subnational and corporate issuers, where we saw a noticeable slowdown in activity.
Well, in terms of the state, overall, the reason for the slowdown is quite simple. The October hike in MPR, October last year, 2.75 basis points, 275 basis points hike to 12%, pretty much shut down the market. Because, and if you look at the October DM auction, the 7-year bond was issued as 18%. This is federal government. So where will states price if federal government's at 18%? And those elevated FGM bond levels continued up till about August this year. I mean, the January auction had a bond 2018 at almost 17%. 16% was typical for auctions or secondary market for much of this year. In those environments, given that the states have to price above the government, federal government, they just could not issue.
So as we round up what has been a pretty eventful year for Nigerian bonds in 2012, what can we expect in 2013? We'll find out after the break.